Recent economic data paints a complicated picture. While layoffs tied to corporate restructuring continue, an even more striking trend is the sharp slowdown in hiring. In January, employers announced plans to fill just over 5,000 positions, the lowest monthly hiring intention recorded since tracking began in 2009. Economists describe the current labor market as low hire, low fire. Those who already have jobs are reluctant to leave them, wary of uncertainty. At the same time, individuals who lose their positions are facing a shrinking number of opportunities. Although the unemployment rate remains relatively modest, the usual job mobility that allows workers to move into better-paying roles has slowed significantly. Against this backdrop, claims that the country has never been wealthier feel disconnected from the lived experience of many households. On paper, overall wealth has risen. Stock markets continue to reach record highs, corporate earnings remain solid, and billionaires, especially those linked to technology and finance, have seen substantial gains in their net worth. However, total national wealth does not automatically translate into broad prosperity. For many working Americans, wages have struggled to keep up with living expenses. Inflation has eased compared to its peak, but still sits above the Federal Reserve's 2% target. Housing remains expensive, grocery prices are higher than they were 2 years ago, and elevated interest rates have made mortgages, credit cards, and auto loans more costly. Even small price increases accumulate over time, placing sustained pressure on paychecks that have barely grown. The widening gap between Wall Street performance and everyday economic reality reflects where investment capital is flowing. Over the past year, the dominant trend has not been a revival in manufacturing or a surge in small business hiring. Instead, significant funds have been directed toward artificial intelligence, automation, and data center infrastructure. Artificial intelligence alone has been cited as a factor behind thousands of job reductions. Companies increasingly promote AI systems as substitutes for human roles in customer service, programming, marketing, and logistics. Meanwhile, massive data centers, energy-intensive facilities powering AI models and cloud platforms, have become central to this investment wave. Although they generate short-term construction and engineering work, they ultimately require relatively few long-term employees compared to traditional industries. The financial gains largely benefit shareholders and tech executives rather than a broad base of workers. This transition intensifies inequality in two key ways. First, it channels investment into capital-heavy sectors that deliver high returns with limited labor participation. Second, it accelerates automation in white-collar and service occupations that were once considered relatively secure. When companies can justify workforce reductions by pointing to AI adoption, employees' bargaining power diminishes. Fear of replacement discourages wage negotiations and limits job switching. The result is an economy that appears robust in aggregate statistics, but fragile beneath the surface. Unemployment remains low by historical comparison, yet hiring momentum has nearly stalled. Wealth has reached record levels, but it is concentrated among asset owners, those holding stocks, tech equities, and real estate, rather than wage-dependent households. Official job growth numbers show expansion, yet later revisions suggest earlier optimism may have been overstated. This does not necessarily mean the United States is in recession. Consumer spending continues, and certain industries, particularly healthcare, are expanding. Profits remain strong in sectors that might not traditionally be expected to thrive so significantly. Still, the broader narrative of universal prosperity oversimplifies a more complex reality. The nation may appear wealthier overall, but that wealth is unevenly distributed and increasingly tied to ownership of capital rather than earned income. If political leaders continue celebrating market indices while overlooking wage stagnation and labor market vulnerability, public frustration is likely to deepen. Economic well-being cannot be measured solely by billionaire net worth or the market capitalization of AI companies. It must also be evaluated by whether ordinary workers can secure stable employment, move to better opportunities, and afford basic necessities without accumulating debt. The latest jobs report, featuring headline gains alongside sobering downward revisions, captures this contradiction. For millions confronting stagnant pay and rising expenses, the promise of national wealth feels distant. While political elites and major investors may be enjoying record prosperity, many others are finding it increasingly difficult to make ends meet. In some cases, households face mounting hardship, financial strain, and a growing sense of being overlooked. Please subscribe my channel for more informative videos. See you soon. Bye.